Welcome to our channel. Have you ever stood in front of a mirror and wondered why some people seem to have money practically falling out of their pockets while the rest of us are digging for loose change under the sofa cushions? The secret often boils down to one magical, elusive, and frequently misunderstood word: assets. But what exactly is an asset? Is it a gold-plated toothbrush? Is it that dusty collection of comic books in your attic? In the world of wealth creation, an asset is essentially anything you own that has the power to grow and generate income for you without requiring you to work a 9-to-5 job for every penny. It is the ultimate work smarter, not harder strategy. When you own quality assets, they utilize a process called compound interest, which is basically your money having its own little money babies, which then grow up and have even more babies. This compounding effect is the engine of wealth accumulation. Many of these assets create passive income, meaning you are earning while you sleep, eat, or try to figure out how to fold a fitted sheet. It is like planting a money tree that keeps bearing fruit even if you stop staring at it. Today, we are exploring the 12 best assets in history that can help you build your own financial forest, step by step. Our first asset is one that people often forget until it starts making weird noises: your health. It might sound like a cliche, but health is truly your most precious asset and the foundation of all your wealth. As the old saying goes, if you keep the green mountain, you will never run out of firewood. Having a healthy body is what allows you to actually earn an income, make logical financial decisions, and, most importantly, enjoy the fortune you are working so hard to build. If you are not around or are too sick to enjoy your millions, the numbers in your bank account are just pixels on a screen. Investing in your health isn't just about paying for medical insurance. It involves a lifestyle of regular exercise, a balanced diet, getting enough sleep, and managing your stress levels so you do not explode. It also includes preventative care, like regular checkups, so you can catch problems before they become expensive nightmares. When you are physically fit, your mind is sharper. You have more energy to chase opportunities, and you will likely spend far less on medical bills, leaving more cash for your actual investments. Investing in your health is a direct investment in your long-term financial security and overall quality of life. Next up, we have the personal retirement account. These are common all over the globe, though every country likes to give them their own special, sometimes confusing names. The brilliance of these accounts is that they offer tax incentives designed to supercharge your investment growth. By investing over the long term, you can accumulate a significant nest egg for your sunset years. In the United States, for example, you have 401ks and IRAs, which allow you to use your income to buy assets while planning for future wealth. These accounts offer a good deal of flexibility in what you can buy and when you can take the money out. In China, the system often combines pensions with enterprise annuities, where both the employer and employee contribute, though it tends to be less flexible regarding early withdrawals. Meanwhile, Taiwan uses a mandatory retirement system, including labor insurance and occupational pensions, focused on providing a basic safety net. No matter where you live, it is vital to research your local system, because these accounts are designed to ensure your future self is financially stable and can take advantage of that sweet compound interest. If you are new to the game, mutual funds are often a fantastic place to start your journey. Think of mutual fund as a giant potluck dinner where everyone brings a little bit of money and a professional manager is hired to decide what to buy for the feast. The primary goal here is to achieve long-term capital growth or steady income. The biggest superpower of a mutual fund is diversification. Instead of putting all your money on one single company that might go bankrupt because of a bad tweet, a mutual fund spreads your money across various stocks, bonds, or other securities. This dramatically lowers the risk that one single failure will ruin your entire portfolio. There are equity funds for those who love stocks, bond funds for those who prefer fixed income, and hybrid funds for those who want a bit of both. While they are easy to use and often offer automatic investment plans, you must pay attention to the expense ratio. This is the fee you pay for the fund's operation, and it is expressed as a percentage of your investment. Generally, the lower the fee, the more money stays in your pocket to keep compounding. Moving on, we have index funds, which have become incredibly popular because they are simple and tend to deliver great results. These are passive investment tools that basically just mimic the performance of a specific market index, like the S&P 500 or the NASDAQ. Because there is no expensive manager trying to outsmart the market by picking individual winners, the costs are usually much lower than actively managed mutual funds. These lower fees can significantly accelerate your wealth building over decades. Another huge plus is diversification. By buying an index fund, you are essentially buying a tiny piece of every company in that index. It is an effective way to reduce risk without having to spend your weekends researching every individual stock on the planet. Index funds are perfect for the buy and hold investor who doesn't want to stress about market timing. Historically, major indices have shown steady, robust growth, which is why these funds are so beloved. They are also very liquid, meaning you can buy or sell them through a brokerage account whenever the market is open. For those who want the diversification of a fund but the speed of a stock, we have ETFs or exchange-traded funds. Like mutual funds, they hold a variety of assets, but the big difference is how they are traded. ETFs trade on an exchange, just like individual stocks, meaning you can buy or sell them at market prices at any time during the trading day. This gives you a lot of flexibility and liquidity. ETFs often have even lower expense ratios than mutual funds and are structured in a way that can be more tax efficient. When you sell an ETF, it is usually a capital gain or loss, whereas mutual fund redemptions can sometimes trigger complicated tax distributions. You can find ETFs that track specific industries or sectors, which is a great way to bet on a certain part of the economy without having to pick one specific company. However, be careful with specialized or leveraged ETFs, like inverse ETFs, which are designed for short-term trading and carry much higher risks that might not be suitable for long-term investors. Of course, we have to talk about the granddaddy of wealth building, the stock market. Buying individual stocks is the most direct way to own a piece of economic growth. When you buy a share, you are literally a part owner of that company, and your returns are tied to its profits and stock price. The main draw here is the potential for high returns. Historically, stocks have outperformed most other types of assets over the long haul. But, and this is a big but, the stock market can be a wild roller coaster with massive price swings in the short term. To succeed, you need to do your homework and research a company's financial health, its competition, its growth potential, and the quality of its management. You can use tools like the P/E ratio to see if a stock is overvalued or a bargain. Diversification is still the golden rule here. Try to spread your investments across different sectors and industries. You need a strong heart to handle the volatility, but if you have clear goals and a long-term mindset, the stock market can be a powerful wealth generator that beats inflation. If you like the idea of stocks, but you also like getting a thank you check in the mail, look at dividend stocks. These are shares in companies that regularly distribute a portion of their profits back to shareholders as cash dividends. This is a classic source of passive income that can either fund your lifestyle or be reinvested to buy even more shares, creating a massive snowball effect over time. Investors who value stability often love these, as companies that consistently pay dividends are usually mature and financially healthy. They can even act as a hedge during market downturns, providing some income even when stock prices are dropping. You will often hear about blue chip stocks, which are reliable, large-scale companies. There is also an elite group called dividend aristocrats, companies in the S&P 500 that have increased their dividends every single year for at least 25 years. They might not always skyrocket like a tech startup, but they offer a steady, reliable income stream that is hard to beat. Just remember to check the dividend payout ratio to make sure the company isn't paying out more than it can afford. Now let us talk about the asset that has been making people rich since the dawn of civilization: real estate. People invest in property for two main reasons: rental income and appreciation. Rental income provides a steady, reliable flow of cash, as tenants pay you for the privilege of living or working in your building. On top of that, as you pay off your mortgage and the property value goes up, your personal wealth grows. Real estate is also famous for the power of leverage. You can often buy a property using a mortgage, which means you can control a very large asset with a relatively small amount of your own money up front. When the property value rises, that leverage can significantly amplify your returns. You can invest in residential homes, apartments, or even commercial spaces like offices and shops. If you don't want to be a landlord and deal with broken water heaters at 2 a.m., you can look into REITs real estate investment trusts. These allow you to invest in a portfolio of properties with the liquidity and ease of a stock. Just keep in mind that real estate requires active management, an understanding of market cycles, and a fair amount of initial capital for down payments and closing costs. For the investors who prefer to sleep soundly at night without worrying about market crashes, there are government bonds. These are essentially loans you make to the government so they can fund public projects or manage their budgets. They are widely considered among the safest investments because they are backed by the full faith and credit of the issuing government. When you buy a bond, the government promises to pay you back your original investment plus interest over a set period. In the U.S., you have Treasury bills for the short term, Treasury notes for the medium term, and Treasury bonds for the long term, sometimes lasting over 10 years. These provide a predictable income stream and are excellent for preserving your capital. Often, the interest you earn is exempt from certain taxes, which is a nice bonus. While they are very liquid and safe, the downside is that the returns are usually lower than stocks or corporate bonds. For long-term investors, the return on a bond might only be slightly higher than the rate of inflation. Next, let us dive into commodities. These are raw materials or agricultural products that are traded in standardized forms on various exchanges. We are talking about energy products like oil and gas, agricultural items like wheat and corn, and precious metals like gold and silver. People love commodities as a hedge against inflation. When the economy gets shaky or inflation starts to rise, the prices of these raw materials often go up as well. Gold, for instance, is the classic safe haven where investors hide their money during times of global chaos. Commodities also help diversify your portfolio because their prices don't always move in the same direction as stocks and bonds. You can invest by buying physical items like gold coins, or more conveniently through commodity futures or ETFs that track these industries. Just be aware that commodities can be very volatile based on geopolitical events and supply and demand shifts. Also, holding physical commodities like gold might come with extra costs for storage and security. Don't overlook protective assets, better known as intellectual property. This includes copyrights, patents, and trademarks that protect your creative or innovative work. Copyrights protect original works like books, music, movies, and software. If you own a copyright, you have the exclusive right to distribute and profit from that work. This can lead to ongoing royalties every time your song is played or your book is sold. Patents protect inventions and new technologies, giving the inventor exclusive rights for a certain period. Successful patent holders can make a fortune by licensing their tech to other companies. Then there are trademarks, which protect brand names and logos. A strong brand is a gold signboard that gains trust and recognition in the market, and you can earn fees by licensing your brand to others. While protecting these assets can be legally complex and expensive, a successful piece of intellectual property can provide a continuous stream of passive income for many years. Finally, we have the heavyweight champion of wealth building, business ownership. Owning and operating a business is one of the most direct ways to achieve high returns and massive wealth. Whether you start your own company, buy an existing one, or join a partnership, you are using your skills and hard work to build something of value. Being the boss gives you the power to set prices, manage costs, and scale the business to increase profits. Successful businesses generate significant cash flow and tend to appreciate in value over time as they grow and expand into new markets. If you ever decide to sell, that increase in business value can be a life-changing payday. There are also various tax benefits, such as deducting business expenses and depreciation, which help you keep more of what you earn. Of course, running a business is not for the faint of heart. It requires total dedication, the ability to handle financial risk, and a spirit that can face constant competition and market changes. Accumulating wealth is not a sprint. It is a long-distance marathon that requires patience, self-discipline, and a willingness to keep learning as the world changes. You can use these 12 assets as a framework to build a strategy that fits your own financial goals and lifestyle. If you are diligent and patient, your wealth will grow over time, and you will find yourself on the road to true financial freedom. So, which of these assets do you currently hold? And what is your big plan for them in the future? Share your thoughts and strategies with us in the comments section below. We love hearing your stories and ideas. Thank you for watching our deep dive into wealth building. If you found this helpful, please remember to subscribe to our channel and like this video to help us grow and keep bringing you more content. We will see you in the next one.